Good morning, ladies and gentlemen. Welcome to Czech National Bank and to our meeting with analysts. We are going to present you our latest macroeconomic forecast. And after that, we will open the floor for your questions. But before we start, let me introduce you our today's speakers. Vice Governor Evy Zamrazilové, Executive Director of Monetary Department, Mr. Petr Sklenář, and Jakub Matějů, Deputy Executive Director of Monetary Department and Director of Forecasting Division. So, Jakub, floor is yours.
Okay, thanks a lot. I will start right away with the presentation of new macroeconomic forecast. As usual, I will walk you also through our scenarios and which illustrate the risk assessment around the forecast. But first of all, let me kick off with let's say an overarching topic of this forecast, and that is that we consider the economy to be in a very good shape to face the Hormuz shock. Just looking at the headline numbers, but also comparing them in the regional perspective, benchmarking to the region, together with Poland, the Czech economy records relatively robust growth numbers, which are consistent, let's say, with the potential growth of the economy. In terms of HICP inflation, which I selected so that I could compare the countries, we even recorded the lowest inflation in the region in March 26. 1.5. Last year, the current account deficit was mildly positive, but consistently so, and monetary policy rate is well above HICP inflation, meaning that the monetary conditions are restrictive. You possibly couldn't imagine a better state, a better shape when to face a supply side oil price or energy price shock like the one following from the conflict in the Middle East. With that, we go into the forecast. I guess that everybody who has been in the forecasting business in the last month or two must have headaches with oil price revisions every second day, moving above 100 and below 100. So given that we had our cutoff date almost 3 weeks ago, it stays relatively relevant until today. So the outlook assumes 96 USD per barrel in Q2, coming down along the Brent curve towards below 80 towards the end of the year, with natural gas prices staying close to 50 euro per megawatt hour until the end of the year, and then coming down below 40 next year. We also work now with a reduced steady-state growth of foreign economies from 1.6 to 1%, with consequent changes in steady-state Czech exports and imports from 4.8 to 3.5. Still, this has a very limited impact on the forecast because these changes we have been accounting for using expert judgment for already several quarters. So this is just to note that we have finalized this process of bringing the foreign steady states down. We also work with the assumption of slightly lower outlook for real estate price growth, given the observations of moderation of the previously rapid house price growth, now moderating a little bit. And last note that the forecast was finalized before the releases of flash CPI and GDP. To give you the summary, the overview of our forecast, we expect inflation to be at 2.2 this year on average. I will show you shortly the profile, then coming somewhat up in the next 2.4, driven mostly by the start of the year numbers. Then after that, the inflation converges back to the target. In terms of GDP, we expect 2.5 this year. That was built before the GDP flash release, and 2.7 next year. Average nominal wage, we expect to come down from 7.2 recorded last year to 6.4 this, and further down to 5.4 next year. But these are still elevated numbers compared to historical averages and our estimated steady states. The rates are consistent with this forecast, come up somewhat this year before reducing again in 27. Exchange rate is broadly stable according to the forecast. Coming back to the foreign environment outlook, we expect, according to the pricing, that the 3 months SOFR rate in the US will be roughly flat this year, coming slightly down in the next. For the ECB or euro rates in general, we expect mild increase in euro area market rates, which are consistent with one hike of the ECB in June and nothing else. The pricing has been volatile also in foreign rates, so we have taken this judgment-informed approach of assuming one ECB hike in June. Touching on the foreign GDP numbers, I've already said that we have revised the steady state downwards, but also the recent numbers expected for Germany, we are revising downwards to 0.6 this year, coming slightly up next, 1.2, but both are revised downwards from our previous assessment on the back of the supply side shock coming from the Middle East tensions or conflict. On the profile of headline and core inflation, we have started the year on very good numbers or pleasant numbers, 1.4 in January, 1.6 March, then we are now very close to the target, 2.4 according to the flash estimate, 2.5, sorry, which is broadly consistent with our second quarter outlook. So the flash estimate of CPI does not bring material news to the forecast, which it's fairly on. We would expect 2.4, the number is 2.5, so this is a rounding error, I would say. And we expect inflation to come up in the year-on-year terms towards 3%, peaking at 3.1 in early 27 before converging back to the target. Regarding core inflation, it stays around 3% or 2.9 to be precise until the end of the year. After that comes down to the target, to the 2% target, which will be helped by leveling off in house price pressures, which we see as peaking now in this quarter and to dissipate going forward. And another helping factor will be the slowdown in wage dynamics, which nevertheless stays elevated, also contributing to elevated numbers in core inflation this year. We have been a little bit more surprised by the GDP growth in the first quarter of 26. which came weaker than we expected and weaker than we would guess from the monthly data. Also, I would remind of today's release for service sales and retail sales, which were relatively strong and do not give much arguments for consumption, for private consumption stagnation, as indicated by the commentary of Czech Statistical Office. So, keeping in mind that the forecast the flash release revisions by the Czech Statistical Office in last 2 years were dominantly on the upside, the average revision in last 6 quarters is 0.2. So we can think that we might see a revision upwards again. If not, the culprit might be in the net exports, maybe stronger imports, but we'll see the more detailed numbers with the release. In overall GDP growth, we revise it from 2.9 to 2.5 this year. And for the next from 2.9 to 2.7. Consumption is expected to be the main driver of growth based on the real income growth, and the foreign demand is revised downward, but still expected to gain momentum, supporting the growth next year. Also giving an impulse to investment activity and net exports. The exchange rate, Euro CZK, is expected to be broadly stable on the forecast horizon. What is very interesting always and important for you is the revision of the rates trajectory. So facing the supply shock and the energy price shock, it is revised upwards. On the shorter horizons in the second and third quarter, marginal also fourth quarter next year, this year, and next year downwards, with the contributing factors to the upward revision being concentrating around the Hormuz shock and the supply side constraints, which is the green one is related to the short-term inflation outlook. These high energy prices spilling over to other parts of consumer basket. The administered prices, which is related to the prices of energies for households. And also with sizable contribution of other foreign shock, which is dominantly foreign price pressures, and the foreign rates, which are for the ECB are revised marginally upwards. On the downside, we have important contributions from initial conditions, and initial conditions are mostly related to real activity. So even before the flash estimate for the first quarter, we have been revising the growth nowcasts downwards. The flash estimate bring it a little bit further down. And also the productivity developments last year were not so bad as we were estimating earlier. We also reduced somewhat the judgment reflecting the lower outlook for a real estate growth, which is then visible or contributes in the gray part. But let me move on to the scenarios and risks. As it is natural facing this type of huge energy price or oil price and generally supply side risk, we need to approach this somehow. So we work with around the baseline, which is the blue line. We have a somewhat more pessimistic scenario that oil prices stay elevated around 100 USD per barrel for 2-3 more quarters before coming down towards 80 towards the end of next year. So this is a very slow return of Brent prices compared to the market pricing, which is closer to the blue line now. Which then this stagnation of Brent prices or the reluctance to correct leads to lower growth in foreign economies, to more aggressive ECB reaction, delivering 3 hikes, and more pronounced foreign price pressures in terms of producer prices. On the other hand, we can imagine like faster resolution of the conflict with relatively early opening of the Hormuz Strait, bringing the oil price down to 85 in second quarter, and further correction below 75 towards 70 towards the end of the forecasting horizon. Still, this line is not at the values from the start of the year, because some of the capacities were destroyed, and the tensions will persist to some extent, but the opening of the strait would bring us to, we estimate, to these levels. Foreign GDP would get some positive impulse from that, with the ECB allowed to stay without any move, and with lower PPI inflation pressures from abroad. How does it translate to the Czech economy? The red scenario leads to weaker CZK, lower growth, which approaches 2% towards the end of the year. The implied rates, which go to 4.5 towards the end of the year, and inflation peaking somewhere below 4%, 3.8 would be the number. The yellow scenario then, with a rapid resolution of the conflict, leads to roughly stable Euro CZK, somewhat stronger than in the baseline scenario, higher growth, stable rates in this economy, and inflation peaking only around 2.6, 2.7 early next year. So this gives us the, let's say, the interval in which we are realistically considering what could happen, and what is the consistent development of Czech main macro variables. Then we worked with a third alternative scenario, where the Hormuz shock and the elevated oil prices, which are consistent with the worst scenario of the previous slide. So this pale blue is the Brent oil price is same as the red in the previous slides. So the like worse energy price shock translates to faster economic downturn, or more severe economic downturn in the global economy. I mean, we can see this, the signs of this, or the risks that this can materialize. For example, in the if some of the for example, kerosene might become unavailable, restricting international travel. The fertilizers their inability to ship them to Europe can lead to more stagnation if we pair it with a bigger uncertainty, which would restrict investment activity due to global uncertainty, decline in consumer sentiment due to higher energy prices, and increased savings rate. We can get something close to foreign economic stagnation. Basically, these events kill off the German recovery as it is expected in the forecast, and also weighs on other parts of foreign demand. This would lead the ECB to stay without any move, restricting also some of the price pressures due to lower demand. This would lead to still weaker CZK, lower GDP growth in Czech economy, and stable rates in the very near outlook, with the possibility of reduction towards the end of the year and the next. Also, inflation is lower because the negative demand pressures dominate the supply side. Important part of this scenario is also increase in long-term interest rate due to higher risk premia and inflation premia. This is dampening the effect on lending activity and investment, and also lower house price inflation. Yeah, so that would be for this scenario, which we consider that it can happen, and we see some risks of this development. But let me stop here. I will leave this table on the projection, so you can investigate it further, and give my word back to Jarek.
Okay, thank you for your presentation. Now we can open the floor to your questions. Just don't forget to activate the microphone and shortly introduce yourself. Please.
Martin Paul, General Investments. I have two questions. The first one relates to forecast assumptions. Could you elaborate on the assumptions, especially on the Euribor assumption? That is significantly below the current market trajectory. In broad perspective, actually the assumptions behind the high energy prices scenario are much closer to the current situation in the markets than the baseline. So could you elaborate on it? And maybe one more to the assumptions. Are also somehow the broad agriculture prices reflected in the forecast? Because over the past weeks we have observed also significant increase in global agriculture prices indices, also in metals indices. So there is quite a big price shock. And the second question, it's maybe related. It concerns more Evy Zamrazilové. So far the response or the communication from the Czech National Bank has been relatively calm to the current situation, which is in big contrast to the communication from Western central banks. Last week we had a rate hike in Norway. There are rate hikes in the pipeline for the ECB and other European central banks for June. The Czech National Bank is not alone in this communication. We hear similar communication, for example, from the Polish central bank. And also, I would say, majority of analysts also share this view. What is, in your opinion, the difference between us and, let's say, Western economies, Western Europe, that should us to believe that the effects of the war, of the price shock, will be relatively mild here? Thank you.
Yeah, okay, I can start. What to say? We had our cut-off dates, as I said, almost 3 weeks ago. So we took a look at the curves back then. I think it stays very relevant until today. Maybe maybe today's curve would be somewhat above because of the news over the weekend. But on Friday, the Brent 1 month forward was 95. So or I don't know if it was Friday, but Thursday or Wednesday last week. So I believe it stays relevant. And how does the scenario differ? Is in the persistence of the shock. So the Brent stays above 100 for 2 quarters, then comes down only to 98 or something like that in this bad scenario, and stays like above 95 until the end of the year. So this is not in today's pricing, and the persistence of the shock and the fact that it does not go away is something what distinguishes it from the baseline most. I speak of this integral between, or the difference between the two trajectories, not only in the second quarter but further on. The question on the agricultural prices, we are following that. Also there we are in a situation which is good starting point, I would say. We still see year-on-year decreases in some of the agricultural commodities, still feeding through to food prices in the Czech economy. So we have had some anti-inflationary surprises from food prices recently, which go consistently downwards. So this brings another cushion which can help us to facing the shock. But we are following that closely, and it's not something we like to see generally.
Finished? Thank you. Your question was about our different attitude to communication in comparison with ECB and other countries, and of course some analysts maybe, and I will respond immediately. But let me first, please, just one comment on those scenarios. These scenarios themselves, each of them is rather an extreme, which allows to illustrate the impacts of uncertainty and risk on both inflation and economic activity, because we all know that this shock is of a stagflationary nature. Uncertainty has many dimensions, and duration of the conflict, elevated prices, impact on energy and other commodity prices, of course food prices, etc. But no one of them will really happen. It's just a guide within the limits how to consider range of outcomes. Each member may have picked some of the details and the outcomes, because these are just this is just an illustration of possible course of actions, because each scenario has its own narrative, its own consequence of economic reaction. So please, we do perceive these scenarios like that, and we do not now. Any of us didn't. All of us perceive these scenarios in this way, and I don't think that any of us could make any forward guidance with respect to some of the specific scenarios. Yeah, and now I will respond to your direct question. Well, if you remember February, before the Hormuz Strait problem, there were even considerations whether the so far low inflation environment hadn't been friendly enough to allow one more cut to finish the cutting cycle. Well, it's gone with the wind from Hormuz, of course, now. And we probably feel that the next move will be either stability or hike. But in comparison with, for instance, ECB, and also in comparison with the previous shock from 2022, we are in a much more comfortable situation. We are in a much more comfortable situation than the ECB, because we have now experienced 27 months of inflation within the tolerance band. This is a huge, I would say, a huge difference in the underlying inflation environment when compared to 2022. And if we look and our rates, real rates are positive, even under inflation at 2.5, and the rates 3.5. We are in a positive territorial with the real rates. And where is ECB? With inflation 3% and rates 2%, they are deeply, or not deeply, but they are in negative territory, in positive territorial. Negative real rates territorial, of course. And they are the inflation. If we look at the dispersion of inflation between individual countries, there are some countries with inflation starting by figure 4. And so for them, the monetary policy is very easy for now. So the situation of the ECB is rather difficult, and for me, we will know whether there will be 1 hike, 2 hike, 3 hike, maybe more. I don't know. And now about the opinion of the analysts. Well, a part of our decision, these were your estimates, because in our IOFT, April IOFT, the inflation expectations seem to be perfectly anchored, while because majority of you, our respondents, is convinced that the inflation will be in a 1-year horizon up to 2.5. There are just 2 extremes, 4 and 5. There are just 2 analysts, I don't know who, but most of you expect up to 2.5. There is also 1 or 2 below 2%. And at the same time, just 2 of the respondents expects a rate hike in a 1-year horizon. So the majority of the last IOFT survey has shown us that you are convinced that the price stability can be sustained even without monetary policy reaction. And this is of course an issue, whether this shock can be overcome without monetary policy reaction. If there is, for the time being, we do have only the first round effect at play, and we have room enough to consider and evaluate the new fresh data carefully, not to do any premature and hasty step followed soon by rate cuts. In comparison with 2022, we are in a much more comfortable position. We have 27 months of inflation around the target, while in February 2022, there are 50 months. There had been 50 months with inflation above 3. And the inflation in February 2022 was around 10%, and the rates were 4.5. So they were deeply negative. So every shock is coming in a different environment, propagates itself via different channels, and the monetary policy reaction will come if necessary. We are ready.
Mr. Ruška first.
Hello everybody, I'm Ruška, GNT Banka. Thank you for the presentation. I have 2 questions regarding the forecast. First is to the construction of the baseline. I was wondering if you looked in the possibility of potential underestimation of inflationary pressures stemming from the oil prices, given the historical difference between realized price of Brent, the dated Brent, and the futures Brent, because in last months there were like 40 or almost $40 per barrel, and given most of us use futures, which were in the time lower, that this could lead to an underestimation of inflationary pressures. So if you've looked into this. And the second question is regarding the monetary policy or the interest rate trajectories, as the baseline expects increase and the decrease. I was wondering if you looked into what would be the inflationary costs of keeping the monetary policy rate stable across the horizon within the model framework. Thanks. That's all.
Thank you for the question. I will start with the first one. There could be a lot of, I would say, degree of freedoms about uncertainty in the baseline. So we did not incorporate in any non-standard measures in this scenario, whether there is about the crude oil price. But we are aware of this situation. It's another way, it's the discussion about the refinery margins and increased crack spreads. We follow the situation. We know that the diesel price is higher than it would have been without this increase. But it's not incorporated. And as I said, it's part of the uncertainty and impact of, because it's difficult to make strong assumption whether it's only short-term issue or it would have longer impact during the rest of the year, but it's not incorporated.
And the second question, if I recall or if I understand correctly, is on the cost of monetary policy inaction on inflation outlook. We do not prepare a scenario for publication in that direction, but generally speaking, you would expect that without monetary policy restricting some of the spillovers to some of the second round effects, the inflation will be higher, maybe move closer to the red line in the Hormuz scenarios.
Okay, so Mr. Dvořák, please.
Thank you. Tomáš Dvořák, Oxford Economics. Thank you for the detailed expositions. I'll move us from the Hormuz Strait a little bit onto the demand side. 2 questions. The first one's on the output gap. I've noticed that there's been a mild downward revision in the latest projection, but the output gap's still positive in 2027, meaning the economy is above its potential. There's also been a downward revision on the government balance, which breaches 3% of GDP in 27. So how do you assess that in terms of inflationary pressures? And specifically, do you look at the expected structure of government spending and what that might mean for inflation? So the first question. And the second one, it's been briefly alluded to in the scenarios, but a question on the savings rate, the household savings rate. What's the bank's assessment on that? Because it's still above the pre-pandemic average of, was six percentage points above that. And part of that is likely permanent. In fact, the Czech National Bank put a very good research note on this topic out a few months ago. So what's your view on how does the savings rate respond to the supply shock? Because in a sense, we can imagine it going both ways, either up or down, or staying flat.
In terms of output gap, as was mentioned, we already in initial conditions thought that the growth dynamics of the Czech economy will be slightly lower, and we are close to the potential, not above the potential. So there is less risk stemming from the overheating of the economy, and we think that we are close, or at this point slightly below the potential. So.
Yeah, just to give some numbers, the flash estimate, let's say that it postpones the period when output gap will turn positive, according to our reading. So now the estimated output gap for this year is still marginally negative, 0.1 negative, as average of this year, coming positive only the next. So this quarter-on-quarter volatility just brings us just above the potential, just below. And maybe I would move to the saving rate, which we now, after the note you are referring to, we now started to expect that saving rate wouldn't come down to anywhere close to historical averages, which were 12%. So nowhere there. There are many factors behind that. Some redistributive factors which are connected with the super gross wage abolition in 21, which would bring it 1 or 2 percentage point upwards, just from the redistribution effects, but also related to the apparent change in behavior of Czech households, which since COVID, since the pandemic, started to invest much more in I would say standard financial assets such as equities, funds, even foreign equity holdings. These factors are visible in all types of statistics, be it BOP or the national accounts, and this would contribute to a systematic upward contribution to saving rate of around 5 percentage points. So this brings us to a steady state saving rate around 18%. So from 20 to 18 is not that far. So we don't expect any kick to for example, we don't expect any kick to consumption due to a reduction in saving rate. We think this is very limited now.
In terms of public finance. It's a very tough question. Because so that is the reason we more consider the impact of the public finance as uncertainty than a risk, because according to final figures, the expenditure last year was slightly higher. This year there was some provision of the state budget, and so it leads to the slightly lower expenditures. The overall impact in terms of fiscal impulse is slightly lower, despite the fact that the budget deficit is deeper or higher, and we only follow what's including in the projections, only the measures which were officially approved, and I would say that that's more important for the next year than the projection for this year. There are maybe a lot of changes in pipeline in Parliament, and we will change our projection for the next year. But so far, we do our best, and we don't consider as the fiscal impulse in Czech economy after the many revisions is strange is very significant, but it's still slightly positive.
Okay, so Mr. Havanand, please.
Good morning, everyone. David Haviland from ING. I've got basically two clusters of questions. First is, why would you react to a negative external supply shock? So what would you expect from a potential hike in terms of inflation and growth and signaling? And second is this kind of same cluster. Do you perceive the space for a monetary policy mistake? Like, is maybe the ECB close to that, like rising rates premature, and then seeing the economy deteriorate, the activity, and having to cut more than if you would not, or ECB would not rise? So is the situation currently bringing this moment of potential monetary policy mistake, in your view, either for the ECB or for the Czech National Bank? And the second cluster is about housing market and property prices. Should the housing market tighten further, and we would see further increases in property prices filtering into imputed rents, would the CNB fully react to that, or would there be maybe a tendency to look through that as this type of discrepancies is not fully under your control? Thank you.
So your first question was about rate hikes reacting to negative supply shock. Well, I think I have said that we will evaluate new data very carefully, with main respect whether there are some second round effects. I think that a lot has changed in the world of central banking with these shocks coming quite frequently. And so far, I don't see any substantial support in the literature or in the practice of central banks, whether this is correct or not. Yeah, I think that our guideline is mostly to be very careful about the secondary price effects, about the inflation expectations. I have said something about those inflation expectations. That seems anchored to be quite well anchored so far. But of course, situation may have changed already and may change in the future. So that's my point to react on the secondary effects. Well, and now I can speak here just for the majority view of the bank board. I think that the strategy is to have the rates at the lowest possible level, which will not threaten financial, of course, also financial, but mostly price stability in one or in the long-term horizon. So, as I have already mentioned, I think that for the time being, in this monetary policy session, the risk of making a mistake when not reacting immediately, that the probability that it could have been, it could be later assessed as a mistake, that this probability is quite low. You probably react also to the baseline scenario where there are evident higher interest rates, but if we with the advantage of hindsight, we can remind the situation from 2024, when there were more cuts than we had really done, and the reality has shown that we were not mistaken, that now we have, we didn't do any premature cut, and that helps us now to be in a quite comfortable situation in comparison with the past and in comparison with other central banks, mostly ECB. Of course, ECB, we close very carefully the ECB. It's one of our pieces of information coming into our decision, but that's one piece of information. Some of us believe more the theory of UIP, some of us believe less. That's also an issue. And as for the forecast itself, it's just a piece of information for our monetary policy decision making as well. That's a product of monetary policy department, and the decision making process is our burden. So that's it. And now about the housing prices. I think that no central bank has some direct tool to address housing prices. The seed of rising housing prices was the primary problem was in a long period of extra loose in monetary policy, and this is still with us because it became a national sport to buy flats and houses and either retain them or give them to the market with so there is no tool. We try to do something about the investment mortgages. We will see what will the outcome be. Still, we do not know. But what we will really do is the reaction in the form of imputed rent, because I'm convinced that for instance, I'm convinced that the increase of prices of services in April increased from 4.7 to 4.8 probably belonged to the effect of the imputed rent, because the imputed rent now is not reacting only to increasing housing prices, which I believe will hopefully stabilize in the foreseeable future, but the problem is about the two other items of imputed rent, which is construction materials and construction works, prices of construction materials and prices of construction works, and I'm afraid very much that the housing prices, that the imputed rent will increase. We will see what the will the prices of services show in the forthcoming months, because of course this was our main reason why not cutting rates to 3.25. So, yeah, okay.
So, Mr. Buresh.
Thank you. I have two questions. One, was I asked to speak? Yeah. Okay, thanks. Okay, I see Yara still holding hand. I honestly, first one regards inflation. I was a bit surprised with the baseline scenario for 2027. I think, at least from my point of view, it's rather low, the forecast, but I understand it's a matter of assumptions and that you have certain cutoff dates, etc. But still, I would like to maybe dig a bit deeper here and understand more in detail your forecast for 2027, especially what are your assumptions about the food, or what is your forecast of the food prices, if you see any spillovers from currently higher both oil and gas prices to the food inflation dynamics in 2027. And then the non-energy goods as a category, if you see any like secondary effects there for 2027, because also I know those are like flash estimates for the month of April, but still there's been some spike in that segment as well. So if you could comment on that. So this is the first question, my understanding of 2027 inflation outlook, and second one concerns the alternative scenario regarding a triggering economic downturn. I understand the situation is uncertain, that and you can imagine several scenarios, but I get it also that Czech National Bank communicates with presenting the scenario where it sees truly some risks could materialize. So I would try to understand your like narrative, why you fear specifically that kind of scenario, because if you look at the like soft indicators such as PMIs, etc., it doesn't look at all that basically it has any negative impact on economic activity so far. It rather looks like an inflationary impact so far, with a pretty high growth in both input-output prices and potentially the margins as well.
Start with the last question. Maybe coming back to the earlier ones. So I think your question relates to this scenario of a stronger economic downturn as a result of the oil price shock being also more pronounced than in the baseline. I would say yes. This is a stronger downturn, but it's nothing really extreme. Still, we have. Okay, let's start with the foreign economy, where the close to stagnation, or let's say 0.2-ish growth in foreign demand is not something inconceivable. The German recovery towards 1% growth next year is, or above 1%, is at risk. The second quarter seems to be very weak again after the strong first quarter. There are reports of maybe a return to stagnate or to close to stagnation in the second quarter in Germany. So there are signs that this can go forward, but also coming to the Czech economy, there are a number of factors, as I said, like modeling tools, which we used to get to this result. It's sentiment, weighing on investment activity, versus consumption sentiment, precautionary savings, being stronger in face of the cost shock, something comparable to 22 also, that the saving rate comes up, facing the cost price, the higher prices. Then we have this assumption on stricter global financial conditions, not only higher Czech rates, but also stricter financial conditions worldwide, which dampen effect on lending activity, both foreign and domestic, and also the lower house prices. This is something which came up in the discussions with the board when we were going through the forecasting process as a concern. So I would say this is not anything dramatic. When we would prolong the GDP growth longer to the history, we see these numbers like 0%, 1% GDP growth 2 years ago, or even 1.5, and this is like a return to stagnation, which we have seen 22, 23. And then there was a question on food prices. This is a very good question. I've already tried to answer earlier that we are in a very good situation with year-on-year decreases in some food commodities still feeding through to lower food prices, but the situation is turning around very fast now, and to give you some numbers, yes, we expect food prices to be above target next year, peaking 2.8 in the second quarter, but on average being somewhere slightly above 2%. So we have some effect there, but nothing which would be too dramatic. I want to add something.
Yeah, and about the inflation outlook for 2027, it's based on, I would say, two strong assumptions. And one is about the development of energy prices, and we expect in baseline that there will be quite strong decline in energy prices. And in 2027, the average Brent oil prices would be 75 or something like that. So it means one of the reason. Another is there is still some restrictive impact of monetary policy. It was the previous discussion, and one important, I would say, degree of freedom is that the approach of firms or companies to setting prices will remain conservative. And that's a very important factor. We have to follow these indicators. So, and that's the base assumption for the, according to your view, low inflation outlook for 2027. But we are aware that there are this assumption, and it's not about a peak at the beginning of the next year, but about the fading away of the inflation pressures in the remaining quarters.
So time is up. I'm very sorry, but I'm very sorry. So thank you for coming. Thank you for your questions. So many thanks to our speakers, and see you next time.